Commodity price risk, what it means for procurement. Commodity price volatility is one of the most critical challenges in modern procurement and supply chain management. Organizations rely on commodities such as metals, energy, and agricultural inputs. These are standardized materials, yet their prices are highly volatile and driven by global market forces. Unlike differentiated products, prices are not controlled by suppliers or buyers. They are influenced by supply and demand, geopolitical events, currency movements, and external shocks. This creates a fundamental challenge for procurement. When prices fluctuate, organizations face cost uncertainty, impacting margins, budgets, and planning. So the objective is not to control prices. That is not possible. The real challenge is to manage exposure to price movements. And this is where strategic procurement begins. What are commodities? Recap. Before we go further, let's briefly anchor the concept of commodities. Commodities are standardized raw materials traded in global markets. Over time, many products evolve into commodities as differentiation disappears. This is known as commoditization. As products become standardized, competition increases, and pricing becomes driven by market forces rather than uniqueness. Commodities typically have minimal variation and follow standardized specifications. This allows them to be traded efficiently across global markets. They are traded in large volumes and serve as essential inputs for manufacturing, energy, and food industries. Another key feature is grading. A single commodity may have different grades, but each grade is standardized. This enables transparent pricing and efficient exchange trading. The key insight is simple. All commodities are products, but not all products are commodities. And as products become commoditized, price exposure increases significantly. If prices are determined by global markets and cannot be controlled, the question becomes, what can procurement actually do? Beyond financial hedging, many organizations assume that commodity price risk can only be managed through financial hedging. While financial instruments such as futures and options are important, they are not the only solution. In reality, procurement plays a much broader role. Organizations manage commodity risk through three key areas: commercial mechanisms, operational sourcing, and innovation strategies. Commercial mechanisms include contractual pricing structures and long-term supplier relationships. These help stabilize pricing and reduce short-term volatility. Operational sourcing focuses on strategic sourcing decisions and supply chain design. This may include supply diversification, sourcing from different regions, and inventory or stock strategies. Innovation strategies go even further by addressing the root of the problem: dependency on specific commodities. The key point is that these approaches work alongside financial hedging, not as replacements. More importantly, they act before price volatility directly impacts the organization's cost structure. While commercial and operational strategies manage risk, the most sustainable advantage comes from reducing dependency itself. Innovation strategies for managing commodity risk. The most advanced approach to managing commodity risk lies in innovation. Instead of reacting to price changes, organizations redesign products, specifications, and processes to reduce dependency on volatile inputs. This is where procurement becomes truly strategic. Design to cost ensures products meet target cost levels from the outset. Design to value balances cost reduction with customer value. Specification optimization removes unnecessary cost drivers. Value engineering improves functionality at lower cost. Material substitution replaces volatile inputs with stable alternatives. Ingredient reformulation applies similar logic in sectors like food and pharmaceuticals. These strategies shift the focus from reacting to prices to controlling cost drivers. The key transformation is clear: from price management to cost and risk management. Learning reinforcement. Let's bring these concepts to life.
Look at this churning ocean of molten metal and crude oil. It illustrates the violent, unpredictable nature of raw material costs. Sudden price spikes in these markets ripple outward, immediately driving up the cost of manufacturing and transportation across the global economy. Countless industries rely entirely on foundational commodities like base metals, energy, and agriculture to build their products. When these essential inputs experience unexpected market shocks, organizational profit margins shrink rapidly. The standard assumption is that companies manage this severe exposure on Wall Street. To offset the pain of rising raw material costs, finance departments purchase financial hedges like futures and options directly on commodity exchanges. But trading financial derivatives only treats the financial symptom. It leaves the physical supply chain completely exposed. True risk management is an operational capability, driven directly by the procurement team from the inside. Surviving market chaos cannot be treated solely as a finance problem to be traded away. It is a structural problem that must be engineered out of the organization. The first layer of structural defense begins in the procurement office. Here, teams manage exposure through strategic, commercial agreements, long before a single shipment of raw material is ordered. Their primary shield is the long-term supply contract. By locking in pricing structures and guaranteeing supply continuity over extended periods, these contracts insulate buyers from the whiplash of short-term market spikes. For more flexibility, teams use framework agreements. A framework agreement is a contract that predefines the pricing rules and quality standards of a supplier relationship, while leaving the actual purchasing quantities and timelines entirely flexible. This diagram shows an indexed pricing contract in action. An indexed pricing contract is an agreement that links the cost of a commodity directly to a recognized external market benchmark. This indexing mechanism eliminates hostile buyer-supplier disputes. By tying the cost to objective data, the contract transparently shares the market risk between both parties based on actual market realities. These commercial mechanisms legally engineer price stability and predictability into the foundation of the supply chain. Moving from paper contracts to the physical logistics network, commodity risk is also managed through the physical movement and storage of goods. Relying on a single supplier for a critical material creates an acute vulnerability. If one specific geographic region experiences a labor strike, a natural disaster, or a sudden localized price hike, entire production lines can grind to a halt. The direct countermeasure is supplier diversification. Supplier diversification is the strategy of spreading commodity purchases across multiple global regions, diluting the impact of any single supply failure. Organizations also build physical hedges through strategic stockholding. Strategic stockholding involves buying excess critical commodities when market conditions are cheap, holding them in reserve to use later during price spikes. This diagram illustrates the inherent financial trade-off of that strategy. The safety provided by physical inventory reserves must be weighed heavily against the escalating costs of warehousing, insurance, and long-term material deterioration. Intelligent logistics turns geographic diversity and carefully balanced inventory management into a tangible physical shield against market volatility. The deepest level of organizational defense occurs inside the R&D laboratory. Here, procurement collaborates directly with engineering to alter the product's DNA, systematically reducing the need for volatile inputs. They begin with design to cost. Design to cost is a strategy where strict financial limits dictate material selection before a product is even conceptualized, preventing engineers from using expensive commodities early in the development phase. Next is design to value. Design to value is a process that ruthlessly eliminates costly, over-engineered product complexities that do not directly increase customer satisfaction. Procurement also drives specification optimization. Specification optimization involves reviewing and adjusting product specifications to allow more flexible sourcing options. This diagram illustrates value engineering. Value engineering is a systematic approach to tearing down a product to achieve the exact same functional outcome using cheaper methods or fewer parts. A major outcome of this teardown is material substitution. Material substitution permanently replaces historically volatile commodities with stable alternatives, like swapping out rare metals for advanced composites. For food and pharmaceutical manufacturers, this takes the form of ingredient reformulation. Ingredient reformulation is a technique where companies tweak chemical ratios to bypass spiking agricultural inputs while maintaining strict product quality. Engineering a vulnerable commodity out of the product design removes the threat of volatility at its source. Intelligent commercial contracts, rigorous logistical flexibility, and aggressive product innovation form a three-tiered organizational defense system. Together, these internal procurement strategies build a comprehensive structural shield. They allow an organization to operate smoothly and protect its profit margins, completely independent of the chaos in the external markets. While procurement builds this internal fortress, extreme external conditions can still breach the walls. In our next video, we will explore the specialized financial hedging instruments companies use to offset the risks that remain.
A tale of two companies.
So imagine you're a global company, right? And suddenly the prices for things you absolutely need, we're talking steel, aluminum, lithium, they just go completely wild. What do you do? Well, that's exactly the question every major company was asking after 2020. And today, we've got a tale of two titans, two giants who took completely different paths to handle that chaos. Let's get into it.
So, in one corner, you've got Apple. Their strategy, super proactive. It was baked right into how they designed their products. And in the other corner, Ford. They were in a much more reactive spot, basically trying to keep up as market prices just shot through the roof. We're talking two absolute legends of industry, with two totally different playbooks for the exact same problem.
So, you might be wondering, what's the big deal? How different could the results be? Well, let me tell you, this wasn't some tiny rounding error on a spreadsheet. We're talking a difference measured in billions of dollars. Yeah, billions. That's how high the stakes are in this game.
Okay, to really get why they made the choices they did, you gotta understand the battlefield they were on. The whole post-2020 world was just a perfect storm. You had COVID smashing supply lines to pieces, all sorts of geopolitical stuff flaring up, and then bam, the prices for basic materials just went to the moon. Steel, aluminum, lithium, you name it. Every single manufacturer on the planet was right in the middle of this mess.
All right, let's start with Apple. How did they manage to build this fortress right in the middle of all that economic chaos? See, their story isn't just about getting through the crisis. No way. It's about how they built a system that was basically crisis-proof from the very beginning. It was resilient by design. And don't get me wrong, Apple was super vulnerable here. I mean, think about what's in their products. They completely depend on some of the most unpredictable materials out there. You know, lithium for the batteries, cobalt, aluminum. And a lot of that stuff comes from just a handful of places in the world. So when costs started to climb, the pressure on their profits was just intense. And this right here is the absolute core of their strategy. The folks at Apple figured out a really fundamental truth. You just can't control the global price of something like lithium. It's impossible. So you know what they did? They stopped trying. Instead, they put all their brainpower into controlling their exposure to that price. It sounds like a small change in words, but trust me, it's a massive shift in thinking.
This quote just says it all, doesn't it? This is not cost reduction, it is cost control by design. This wasn't about calling up a supplier and trying to haggle for a few cents off this quarter's order. Now, this was about building cost control right into the DNA of the product, from the very first sketch, from the very first engineering meeting. So how'd they actually pull this off? Well, they had a whole bag of tricks, a whole toolkit of innovative strategies. Things like design to cost, which basically means they figured out the price before they even designed the product. Then there's value engineering, a fancy way of saying they looked at every single tiny part to see if they could make it cheaper without sacrificing quality. And big one here, they went all in on using different materials and massively ramped up their use of recycled stuff. They literally designed their way out of being dependent on those crazy, unpredictable commodity markets.
Okay, let's flip the coin and look at the other side. Let's talk about Ford. Their story during this exact same time is a really powerful cautionary tale. It's a perfect example of the huge risks you face when you're just reacting to the storm instead of being ready for it. And man, Ford's weak spots were pretty clear. They were buying a ton of their materials on the spot market, which just means they were paying whatever the crazy high price was that day. They didn't have a lot of contracts locking in prices for the future, which would have protected them. They were kind of stuck with their old supply chains, which offered almost zero protection from what was happening in the market.
And because they were mostly just reacting, there was no safety net, no buffer. So when that tidal wave of price hikes came crashing down, Ford was standing right on the beach. They had to take the full force of that hit, right to the bottom line.
So what did this all mean for the money, for the bottom line? This is the moment where these kind of abstract ideas, proactive, reactive, stop being concepts and start getting very, very real, painfully real. $3.5 billion. Just let that sink in for a second. That's the extra cost Ford was looking at just because of these rising prices. It's a jaw-dropping number, and it's the real, tangible price you pay for being exposed to the market like that.
And you can see it right here. It's a straight line from strategy to outcome. Apple's approach, integrating everything, gave them stable profits and a tough supply chain. Ford's approach, reacting to the market, led straight to higher costs and getting hammered by volatility. I mean, it doesn't get much clearer than that, does it?
Now, to be fair, Ford did start to change things up.
They started making moves to lock in long-term supplies of stuff like lithium and nickel. But here's the catch. They did it after prices had already gone through the roof. And in this game, timing is literally everything. The chance to get ahead of the curve and save a ton of money, it was already gone.
So, after looking at these two incredible stories, what's the lesson here? What's the blueprint for not getting caught in this trap? What are the big takeaways for anyone whose business relies on these kinds of materials?
At the end of the day, when you boil it all down, it comes to this. Just playing games on the financial markets isn't going to save you. It's not enough. Real strength, real resilience, comes from weaving your supply strategy into the very heart of your business, into the design of your products. Innovation, like we saw with Apple, is your single most powerful weapon against these crazy markets. And a reactive strategy? Well, like Ford's story shows us, that isn't a strategy. It's just a gamble.
So I'll leave you with this one big question to think about. Is your company's strategy built on trying to guess the future, on trying to predict these totally chaotic markets? Or is it built to make those markets irrelevant, to innovate your way out of the chaos so it doesn't even matter what the price is? Because the answer to that question, well, as we've seen, it could be worth billions.
Commodity risk management is not about predicting prices. It is about reducing exposure, stabilizing costs, and building resilience. That is not just procurement, that is strategic procurement.